Welcome to the Property Investment Podcast. Now today I speak with Michael Hynes, who's the co-founder of Stamford Capital Australia and Stamford Capital Investments. Now Stamford Capital Australia is an investment and debt originator and broker, whereas Stamford Capital Investments actually has exposure to the unlisted real estate markets in Australia. Now I'm really looking forward to sharing my discussions with you today, where Michael speaks about their $1 billion of transactions every year in Stamford Capital Australia, and then also speaks about the different property sectors that he likes to have exposure to pre and post COVID in Stamford Capital Investments. I hope you enjoy our discussions. The Property Investment Podcast is brought to you by Goose Capital. Goose Capital has, in conjunction with MP Funds Management, provided funding for over $1.3 billion of investment-grade real estate transactions and provided an investment return of 22% across the board, with the lowest being 9% and the highest being 42%. For more, go to www.goosecapitl.com. So you guys have done $1 billion in transactions most years, and leading up to COVID, obviously, you were on the same trajectory.
Yes.
I'm curious to know what the transaction volumes are post-COVID and during COVID.
Post-COVID, I think we're probably running at about 30, maybe 40% of, usual sort of volume activity. And I guess that's probably since June, start of June. We actually had a pretty decent June, and July's been a reasonably solid month. That said, April was frozen. So there was very little activity, maybe 5 to 10%.
1st of Jan to 31 of March, 33 transactions, which is pretty solid. Let's just talk through these. Were most of them refinances, construction funding?
Yeah, I guess, up until the end of March, it was sort of usual flow of business for us. So, most of our business is with sub-institutional investors and developers. The split's probably half construction, half investment asset financing. And as you said, we're sort of doing about $1 billion a year of volume. We did just over $1 billion of volume for June 20. So as I say, it was tracking as it was, as it's usually tracked, and it's generally sort of trended upwards, which has been good for us the last few years. But I guess, as like most businesses, it felt like the brakes got slammed at the end of March. So I guess through March, April, we were doing some business, but a lot of it was just bleed through COVID. Anything that wasn't entirely baked was really put on ice. People were just concerned, confused, and trying to work out what was happening. And that was both borrowers and lenders alike. I mean, the good thing, I guess, in certainly in Australia that we experienced was the banks were pretty stand up, as in, they had term sheets out that sometimes weren't necessarily approved pre-COVID, and they went ahead and they honoured those commitments, which was good for the market. But as I said before, April was quiet. April was a lot of just, I guess, pre-COVID bleed. It really wasn't probably until sort of May, June that we started to see genuine new post-COVID activity. And those volumes are down. Demand is down. People are less certain. There's less transactional activity in market, less buying and selling. So I guess the nature of our work has changed. It's certainly more weighted towards development financing at the moment. As I say, given transactional activity in terms of buying and selling assets is down, so financing for new acquisition is down as a result. And I guess the financing of stabilised assets that we're involved in is typically refinancing, not new asset purchase.
So I think that's one of the most fascinating things about your business. You have a bird's eye view and a coalface view of the capital markets for unlisted real estate in Australia. So you're saying that the transactions you are doing are weighted towards development at the moment, which I would have thought it would be the other way around.
Yeah, I think owners, investment assets, owners, they've really just, I guess, sat tight because people have had issues at the asset level that they've had to deal with. They've had tenants that have had operational issues that they can't pay rent. You've had governments provide framework around rent subsidies and relief and the like. So I guess that's been the focus for most landlords over the last sort of 3 months. Financing has been a bit of an afterthought, and again, and it's obviously been reasonably well broadcast. The banks have been good in terms of deferral of covenants and the like.
Thanks for tuning in to the first 5 minutes of the Property Investment Podcast. The Property Investment Podcast aims to bring together the best minds in the investment grade real estate sector. For the full episode and access to the live follow-up webinar, go to the MP Report Premium subscription at www.my-property-report.com.